The stock market is having another solid year, which is rather impressive given the 20% plus gains that we saw in 2024 and 2023. But are the tailwinds the market's enjoying going to last? Or is it time to start trimming the sails? Will "don't fight the Fed" keep working as an investment thesis? Or is it time to start worrying about trade and tariff issues or that looming concern, geopolitics? Finally, which specific themes and groups in both public and private markets offer the most promise for the year ahead? Joining me to shed some light on all of those subjects and more are two all-new guests on the Money Show MoneyMasters Podcast. They are Tony Davidow, Senior Alternatives Investment Strategist at Franklin Templeton Institute, and Scott Zelniker, Managing Director at UBS, the Zelniker, Dorfman, Carr, and Heritage Group. Gentlemen, welcome to the podcast. Well, Tony, Scott, thank you so much for joining me. Really appreciate you taking some time out to chat about this market. It's amazing, we have another solid year underway here in the stock market after two very strong years in 23 and 24. So I kind of wanted to start big picture, 30,000 feet up, with where you think things stand now and whether this is sustainable in your opinion. And I guess we'll start with you, Scott, and then move to Tony after.
Yeah, Mike, it's funny, right? We're coming off these 2 years, 20+% gains. Clients are always asking me, what do you think the next year is going to hold? And I tell clients we don't predict markets, we navigate them. But I said, if you're really going to hold me to it, I would have said, or I did say, that this year I believe we're going to be plus or minus 5% for the year, simply because of math and numbers, right? We know that multiple 20% years in a row, typically doesn't happen and markets have to digest. But we've got a really interesting backdrop right now. We have the technology revolution that I've talked about many times. In the 1600s, we had the agricultural revolution. In the 1800s, we had the industrial revolution. They each lasted 200 plus years. We are now in the technology revolution that started back in 1980 plus or minus. So we're 45 years in. I think we're going to have a tailwind for the foreseeable future because of that. The other factor that we have going on right now is the old adage, don't fight the Fed. The Fed is now starting to cut rates. For the last year and a half, I've been very vocal, feeling like the Fed really has to be careful cutting rates because we have this backdrop of the unknown with inflation, food, energy, housing. So we have all this, war activity going on around the globe. What if oil prices got impacted? Well, fortunately, they really haven't. Oil's come down. Look at food. We've had crazy weather patterns all over the country, all over the world. Food prices have actually stabilized. So now that you have a tightening labor market, you have the ability of the Fed to start cutting. I actually think they've done a great job, contrary to what you might hear in the popular press. And I've been on various news shows talking about this for the last year and a half. But now we have this tailwind of don't fight the Fed. And I'm going to give you something interesting for your listeners. So the last 20 times since 1980 that the Fed started cutting rates at an all-time high, 20 times out of 20, the markets were higher a year later. So that's the positives.
Got it.
Okay.
Well, I like 20 out of 20. That's a pretty good, good track record.
and maybe, after Tony chimes in, I could talk about some of the risks, in the short run to what we're talking about. But there's really some positive backdrop here to talk about.
Yeah, absolutely. Tony, I know that you predominantly are in the alternatives world. Obviously, you have opinions and thoughts on the public markets as well. So what can you say about equities here and the year that we're having?
Yeah, I think our view coming into the year was similar to Scott's. We thought the returns would likely be a little bit more muted, largely because 23 and 24 were above where they have been historically. Again, the long-term historical average of the markets of 10.2, 10.3. So when you get double those returns in back-to-back years, you expect to see some reversion to the mean. I think there's a couple things to think about as we think about this market. You could almost kind of bifurcate it leading up to Liberation Day and post-Liberation Day. And certainly around Liberation Day, there was this shock to the market where there's a lot of volatility, a lot of questions about what this ultimately led to in the long run. And I think we're still trying to figure that out. But I think the The animal spirits have certainly come back. I think the earnings have been very strong across the board, which have obviously drove stock prices higher. But I think as we look at it, there's certainly risk in the market that I don't think is being fully reflected. I think, Scott made the point about the Fed, and we have the same sort of data that we've been looking at, that when the Fed starts to cut rates, that should be a positive for the market, definitely for the remainder of the year and likely for 2026. But I do think there's some risk out there that really hasn't been taken into consideration in the marketplace. Geopolitical risk. We haven't seen the full impact of the trade tariffs. I think there's some front loading of the data. There's some buying in advance of it. There's also the Supreme Court decision, which will question the veracity of the trade tariffs in the first place, which could unwind that. So I think there's some risk to the market with some uncertainty out there, but certainly I think the market has been very resilient. It shrugged off a lot of bad news. And I think with the Fed cutting rates, that is a clear signal that there's smoother sailing ahead here.
The use of the word resilience I find really interesting because, again, if you look at Liberation Day and what happened, very sharp, but albeit short pullback there. The geopolitics have been in the background, but haven't derailed markets all that much. And as we're recording, we don't know what's going to happen with the government shutdown. Will it happen? Will it not? But these types of things have been thrown at the markets, and we tend to be shrugging them off, I guess is probably how I characterize it. Scott, I'll start with you. Why do you think that we're seeing that kind of resilience here?
Well, markets trade on news, but ultimately adjust to valuations. So I think this increase in volatility is just showing the news cycle speeding up and being more readily available. And I think ultimately markets will trade where they should be valued. And I mentioned potential risk before. Valuation is one of them, right? We are approaching historical high valuations on the market. There's two components to valuation. When you look at a PE ratio, a price and an earnings, there's the price and then there's the earnings. So the big question now during this Fed cycle is, will the E catch up to the P?
Yeah.
Does that make sense?
Yeah, absolutely. Absolutely. Tony, I want to ask you, I mean, since we talked a little bit about the Fed and how both of you have an opinion that it tends to be a tailwind for markets here, how many more cuts are you looking at coming as in the rest of this year and as we roll into 26? Do you think the markets kind of have it right, or are we being too aggressive or alternatively not aggressive enough in terms of pricing in the easing cycle?
Yeah, if you look at the data, it looks like there's a 90% chance in October and a 70% chance before the end of the year. So I think that's probably a given. I think the question is beyond that. What happens in 2026? And again, I think that right now the anticipation is they'll continue to cut rates, but things can change. And again, I think that some of these factors that haven't really come to light yet. Again, the impact of the trade tariffs and the strength and the resiliency of the consumer, which is driving a lot of this behavior, could change that. But I think right now the market is anticipating a pretty high percentage too that we're going to get two more rate cuts for the remainder of the year. I'm not sure that that changes a whole lot on the outlook because it's already factored into the market itself. So I think the shock to the market would be if they didn't make those, and then the question would be, is the Fed seeing something that we're not seeing? So again, what markets like is markets like certainty. They like predictability. Right now, the market's anticipating two more. I think the shock would be if they don't occur.
Got it. Scott, anything you'd add to that sort of Fed question or debate?
Yeah. I mean, I think Tony's right on. This year is kind of baked in, but I think on the whole, it's going to be slower and longer, the cycle. And I actually think that's a positive.
Okay.
Because the big risk and the time where I might change my view and the outlook, even with all that positive backdrop, is if we reach that nasty S word, stagflation, where we have inflation running and we have an economy that's not growing well or at all, and dare I even say go into a recession. So the Fed has to keep the tools in the tool chest to fight off what they need to later. And I think the longer the duration of these cuts, even if the market doesn't love it in the short run. Remember, it's going to trade on news, but ultimately go to valuation. I think slower and longer is actually a positive for the market.
Okay. Scott, I did want to stick with you on this question, and that's we've had this America First type policy approach, but ironically enough, in markets, it's been a lot of foreign markets that have outperformed the U.S. in 2025. Thoughts on why that is, whether that can continue? Just kind of, it just seems, from a common sense approach, it seems almost backwards. I wanted to get your thoughts on that.
Yeah, I've been running money now for almost 35 years. We manage 2.7 billion of client money. And for the 35 years, I've always heard international, international, international. And then when you look back over bigger periods of time, large cap domestic stocks tend to outperform. During moments in time like we're having now, you did see this trade to go international. I think for the first time in, really my investing lifetime, we've had this political sea change in our country that has led money to start to look elsewhere. I think it's temporary. I think all global markets are going to do okay here. But I'm more of a Warren Buffett subscriber. Buy big companies, you understand what they're doing, you invest in them for the long term, you don't trade them. And I still think that the big American, albeit multinational companies, will continue to do well over time.
One quick follow-up on that, since you brought that up. Thoughts on, the Mag 7 or the tech dominance versus other sectors? Is that something, when you look at how you think things are going to unfold, if US and big caps are going to continue to do well, is it continuing to be a tech-heavy story, or are there other sectors that you think might start picking up the slack?
Yeah, I mentioned the technological revolution earlier. That doesn't mean you just go out and buy tech stocks. That means efficiencies across the board. So just by the nature of how they've performed, the large cap tech stocks have become a much larger piece of our clients' portfolios. So at this point, we're adding a lot of equally weighted S&P types of vehicles into portfolios, really as a balance. Because as we know, the S&P 500 is market cap weighted. These are the biggest companies in the world, so they are overweighted in the S&P. So for people that are just taking an S&P approach,
Yeah.
and they might own some of these stocks, maybe they were properly weighted at the beginning, but now they've grown. I think it's a good time to start thinking about some type of equally weighted um, indexing to really complement what may have become an overweight.
Got it. Tony, I want to shift this discussion to alternatives a little bit here. I mean, a lot of investors have turned to alternative assets, private equity, private credit. We see some of these formerly private strategies are now in public wrappers, ETFs, and things like that. What are your thoughts on where we are in that cycle and kind of the impact or implications for investors here?
I think we're a very early cycle. I think the reality is institutions and family offices have been allocating capital to alternatives broadly and private markets specifically for decades and decades. So I think one, it's early cycle. Two, it's a very good thing for investors because now we have products that really make an awful lot of sense. I'll give you something that maybe ties into the discussion a little bit here, and that is that I think one, we need to recognize that the private markets are substantially larger than the public markets. Public markets have been shrinking. They're half the size today than they were 2 decades ago. Scott and I obviously remember, how this has kind of changed over the years. Another way of looking at it is 90% of the companies with 100 million or more in revenue are private. So the private markets, in our view, is a richer opportunity set. And to make them available to individual investors, we think that's a very good thing. So again, when we think about private markets, we think of private equity, private credit, private real estate, and infrastructure. And we think those areas continue to be very, very attractive in the decades to come. Again, we're early cycle here. We're just starting to see advisors allocate capital. If I could, I'd love to pick up on your point, which is I do think that the wrapper or the product structure is very important.
Okay.
Personally, I am not a fan of trying to take something that is very special and illiquid in nature and force it into in a daily val structure like an ETF. So to me, what I think is exciting is we've kind of evolved from first generation of product, which are drawdown funds, long lockups, only available to qualified purchasers of 5 million or more in investable assets, to what we refer to as evergreen or perpetual structures, and they include things like interval, tender offer, private BDCs, and non-traded REITs. What we get there is we get lower minimums, better diversification, typically available accredited investor or below. So to me, what's interesting about that, and that's why a lot of people refer to it as the democratization, advisors can now allocate capital to most of their clients. And in fact, advisors can think about diversification across private equity, private credit, and private real estate. So to me, it's still early. It's a very exciting time, but we've got a lot of work to go in educating both advisors and investors about how to use these tools appropriately.
Got it. And I did want to just ask one follow-up question because you do see it pop up in the media occasionally, and that's if more activity, lending activity, borrowing activity, whatever, is moving to private markets that are less, available to the public in terms of maybe identifying risks versus public. Do you think that's legitimate, and why or why not would you be concerned about that?
I'm not, but I think everyone can have an opinion of it, and I think part of what people are reacting is the amount of money that's gone into private credit, and most of that has gone into direct lending. So about 70% of the flows have gone into direct lending. So some could argue, is direct lending a little expensive here? Spreads are coming down. There's some dry powder. And we'd argue that private credit actually represents three primary pillars. So it's direct lending, asset-based finance, commercial real estate debt. By the way, all three of those have different risk return characteristics, and they all have underlying investments. So as much as direct lending may feel a little crowded at this point in time, we think asset-based finance and commercial real estate debt look really attractive here. You also have an underlying asset, which we think is a value, especially when we have market volatility. I'll give you one finer point on that. And the reason that so much money has come into private credit is because traditional lenders, the banks, have stepped away from lending capital. We don't think that changes. We think banks are going to be very reluctant to lend capital in a post Silicon Valley Bank world where they don't want to have these assets on their balance sheet. So again, I think private credit managers, the really smart ones, can step in, lend capital at favorable pricing, favorable covenants. Remember, covenants light were the big thing 3 or 4 years ago. Now, all of a sudden, the pendulum has shifted from being a term taker to a term maker. So again, I think private credit managers can step in, dictate the terms, the conditions, and allocate capital appropriately.
Got it. As we near sort of the tail end of the conversation, we've kind of covered some of this ground already, but I'll give it just see if we want to expand on any points raised earlier. Maybe your top one or two greatest opportunities as we head into 2026, and maybe one of the biggest risks that stands out there. And I guess, Scott, I'd probably start with you.
Yeah, so again, I think opportunistically we believe in this market and the tailwind, so equally weighted S&P. And I think small caps, as rates come down, it's got the biggest impact on smaller companies. We hear it from our clients that are business owners in the private markets. When their cost of capital comes down, there's big opportunity there. The risks are the earnings don't catch up, and we get to the end of this interest rate cutting cycle. Don't fight the Fed when they come out and say, we are done cutting rates. If the earnings aren't there to support it, that might be a time to lighten up and reevaluate the long-term thesis.
Got it. Anything that you would add there, Tony?
Yeah, so our three highest conviction ideas have been and continue to be private equity secondaries, real estate debt, largely for the reason I just explained with private credit and so much money going in there. And then real estate, which may not sound like a very popular sort of opinion given all the turmoil and all the market attention, but we believe that real estate, actually valuations are down substantially from peak in 21. We think that a lot of properties are available below replacement costs. Now, we would avoid the office sector, but we do think areas like multifamily housing, there are certainly attractive areas. Industrial warehouse. If you think of the reshoring of America, we think there's a lot of opportunity to kind of build and take advantage there, and even areas like life sciences. So again, I think we can be more selective in real estate as we look at the opportunities. But secondaries probably our highest conviction idea. And again, I think that part of it is driven by the market environment where we've seen a slowdown of exits. This morning we saw an announcement of M&A activity. We're starting to see a pickup of IPOs. But for much of the year and much of the last 2 or 3 years, we've actually seen a slowdown of IPO activity, which means that a lot of those institutions who have been allocating a lot of capital are looking for liquidity in the marketplace. Secondary managers can step in, fulfill that liquidity need, buy seasoned assets, which ultimately leads to a better experience for individual investors because they're getting the shortening of the J curve, they're getting diversification across assets, diversification across vintage, GP, and geography. So it's a really nice way for individual investors to leg their way into private equity exposure. So secondaries at the top of the list, real estate debt, and then real estate we think look really attractive. What can derail that? Well, we tend to look at things over the long run. So we don't see any short-term sort of shocks to the market. But I would say that, like Scott, we're definitely paying attention to what's happening in the markets themselves. We're paying attention to geopolitical risk. We have kind of an interesting sort of thing too, where we're looking at the liquidity in the markets which I think is a big thing because liquidity drives a lot of the activity.
Well, listen, I really appreciate you both taking a lot of your time out here today. There's a lot of issues to cover, a lot of opportunities as well. Tony and Scott, we're fortunate that you're going to be joining us at the Sarasota symposium that's coming up. And viewers, if you're watching, both of these gentlemen will be there. That's December 1st to 3rd at the Ritz-Carlton Sarasota. You're going to get a chance to hear what they have to say then, updated year-end outlook, or sorry, year-ahead outlook, which is going to be a great time to plan and look at taking advantage of some opportunities in the new year. So thank you so much for your time. Appreciate it. And if you're watching, you can find details in the description below.
Thanks for having us.
Thank you.